Mortgage rates hold steady, but experts expect more declines in 2024. Mortgage rates held steady to kick off the new year, but buyers can expect further drops deeper into 2024, according to Freddie Mac. The average 30-year fixed-rate mortgage was 6.62% for the week ending January 4, according to Freddie Mac's latest primary mortgage market survey. That's a slight increase from the previous week, when it averaged 6.61%. A year ago, the 30-year fixed-rate mortgage averaged 6.48%. The average rate for a 15-year mortgage was 5.89%, down from 5.93% last week and up from 5.73% last year.
The bank is concerned that maybe inflation expectations might not continue to decline. Services inflation, because of elevated wage growth, might remain a bit sticky.
Between late October and mid-December, the 30-year fixed-rate mortgage plummeted more than a percentage point. However, since then, rates have moved sideways as the market digests incoming economic data. Freddie Mac's chief economist Sam Cater said, "Given the expectation of rate cuts this year from the Federal Reserve, as well as receding inflationary pressures, we expect mortgage rates will continue to drift downward as the year unfolds." While lower mortgage rates are welcome news, potential home buyers are still dealing with the dual challenges of low inventory and high home prices that continue to rise. Cater continued, "Home buyers can find the best mortgage rate by shopping around and comparing options. You can visit an online marketplace like Credible to compare rates, choose your loan term, and get pre-approved with multiple lenders at once." Fed expected to slash interest rates. The Federal Reserve could begin dialing back interest rates as early as the first quarter of 2024. During its December meeting, the central bank announced a third interest rate pause, leaving the federal funds rate at a 22-year high of 5.25% to 5.5%. However, Fed officials hinted that they could begin rate cuts this year, with interest rates expected to drop to 4.6%, according to updated economic forecasts in the central bank's Summary of Economic Projections (SEP). We are anticipating a declining interest rate environment throughout 2024, with rates traders pricing in a 0.25% cut to the target rate by the end of Q1 and a further 0.25% to 0.5% cuts in Q2, which should help ease some of the rate volatility we experienced last year. Imperial Fund Managing Director Viktor Kuznetsov said. That said, originations will continue to be a challenge as mortgage rates will likely settle between 5% and 6%, which isn't materially less than where they are today and does not significantly alter the current housing fundamentals picture. Home prices do not appear ready to come down meaningfully, and we expect starts and apps to remain fairly steady through the year, Kuznetsov continued. If you are looking to take advantage of the current mortgage rates by refinancing your mortgage loan or are ready to shop for the best rate on a new mortgage, consider visiting an online marketplace like Credible to compare rates and get pre-approved with multiple lenders at once. Home buyers want rates to dip lower. 12% of prospective buyers said mortgage rates would need to dip below 6% to make buying a home affordable, according to a recent Realtor.com survey. Moreover, 28% of home buyers are waiting for rates to drop below 4% before they wade back into the housing market. The typical outstanding mortgage has a rate of less than 4%, more than 2.5 percentage points below today's rate. Realtor.com senior economic research analyst Hannah Jones said in a statement, "This gap is likely to keep many sellers on the sidelines, waiting for mortgage rates to come down further." Pending home sales in November leveled off, matching October's record low level, and were 5.2% lower than in November of last year, despite the dip in mortgage rates, according to the National Association of Realtors, NAR.
We might see continued stubbornness on the services side that would impede further progress in getting inflation all the way back to the 2% target.
Rate drop improving affordability. The national median monthly mortgage payment on purchase applications fell by $62 to $2,137 in November from the month prior, according to the Purchase Application Payments Index (BAPI). Home buyer affordability improved in November, with a decline in mortgage rates, providing relief to prospective home buyers, Edward Seiler, MBA's Associate Vice President, said in a press release. MBA expects that affordability conditions will continue to improve as mortgage rates decline, which should generate increased demand heading into the spring home buying season. A decrease in PAPI, indicating stronger affordability, can be attributed to a reduction in borrowed loan amounts, a drop in mortgage rates, and an increase in incomes. However, home buyers' ability to afford homes is still lower than a year ago. Mortgage applicants are paying $160 more, or 8.1% higher, each month compared to the national median mortgage 12 months ago. While rates didn't increase substantially this week, home buyers today are still paying 14 basis points more than 12 months ago, when the average 30-year mortgage rate was 6.48% on January 5, 2023, according to Freddie Mac Rates Archive. Many experts are predicting further rate drops in 2024, though, as the U.S. economy is expecting a soft landing where inflation curbs without a national recession. Rates are poised to drop to around 6% or potentially lower by the end of 2024. If inflation continues to show signs of improvement and the bond market remains less turbulent than during much of 2023, mortgage rates should at the very least stabilize this year, if not show sustained declines. Jacob Channel, LendingTree's senior economist, predicted for 2024 housing and economic market. A for sale sign in front of a home in Arlington, Virginia, on August 22, 2023. Sales of homes in the United States ticked down in July, according to industry data released on August 22, 2023, as elevated mortgage rates and limited housing supply held buyers back. The housing market in the world's biggest economy has been reeling as interest rates climbed, making homeowners reluctant to put their properties up for sale, having earlier locked in lower rates on their mortgages. Housing experts said further affordability improvement could be curbed by a continual supply shortage, especially if lower rates bring back sideline demand. Affordability curbed by lack of listing. Housing experts warn that limited inventory could restrain affordability improvement achieved by declining rates. Without adequate supply, sideline prospective buyers returning to the market could outpace the housing supply and increase competition. Homeowners may still be reticent to move from low-interest rate mortgages, which may be in the 2.5% to 3.5% range, until they are in a situation where a life or job change occurs, forcing them to reconsider their living situation, Lotz said. Total inventory of unsold existing homes, not including new constructions, declined 1.7% from the previous month to 1.13 million units at the end of November, according to the National Association of Realtors. This is the equivalent of 3.5 months of supply on the market, nearly 2.5 months lower than what experts believe to be a balanced and healthy market of 6 months. For context, today's existing home inventory levels are relatively close to the record low of 860,000 units in January 2022, compared to the record high of 4.04 million units in July 2007. But inventory could still see a slight uptick as more sellers reach their tipping point, or the rate level at which homeowners are willing to sell their homes. Most homeowners, nearly 92%, have rates below 6%, Redfin says, but as rates drop to 6% or below, more owners could be open to selling. This would reverse the mortgage rate lock phenomenon that slowed the housing market in 2023, when most homeowners refrained from selling to keep their lower-than-market rates. However, experts don't expect a significant jump in inventory that could bring down home prices, as roughly 4 in 5 homeowners still have rates below 5%, and 1/4 have rates below 3%. We are not going to see a big turnaround, Danielle Hale, Realtor's chief economist, said on 2024's affordability challenges during NAR's Real Estate Forecast Summit. But I do think we are going to see baby steps in the right direction. Rebecca Chen is a reporter for Yahoo Finance and previously worked as an investment tax certified public accountant, CPA. So guys, let me know your thoughts in the comments section below. For more interesting content, give this video a thumbs up, and don't forget to subscribe to the channel for more awesome content. Have a nice day, and I will see you in the next video.